Hello, everybody. Welcome to this Let's Learn the Futures webinar series brought to you by Bursa Malaysia and managed by our company LifeChamp. So we are very excited to see you again on this Futures webinar. So today we're going to talk about very exciting topic, which is the mind game for trading success. Now, as you know, your psychology, the trading psychology is one of the key components in the trading success. Not only you need to know your strategy, you need to know your trading system well, not only you need to know your money management well, but also a lot of times we need to know yourself well. How do you manage your emotions when it comes to trading, and how you can win in the trading game with strong mentality. So today our speaker will share with you the tricks in this topic, okay, which is the trade mind game for trading success. Now, as usual, disclaimer, whatever we share on this webinar is only for educational purpose. In no way that I give any buy or sell signal to buy or sell any futures contract. So the long or short any futures contract, if you decide to do any trading decisions, you do it at your own risk. Now here's the PMD webinar. We have gone, this is the 20th session, so we have gone a long way. So we only have 2 more remaining for this year. Okay, wait, I think we have 3 more remaining for this year because we have decided to add on one more topic, which is on FM70. So these are our remaining one with the FM70. So if you don't want to miss our Bursa Malaysia derivative webinar, so these are the 2 days that you need to log reserve, which is 10th of December and 17th of December. Okay, where we will talk about uh, uh, money management and risk management in the futures market in the Bahasa Melayu. Then we will talk about Fibonacci 期货交易策略 in the Mandarin. So allow me to introduce the speaker today. So he is a trader and managing partner of Exmodius Trading Group, a consultancy firm specializing in bespoke trading strategies and coaching for private and corporate clients in the equity commodity derivative markets. He has 24 years of experience in Malaysia's listed derivatives industry. So before starting his own consultancy, he held leadership positions in futures brokering divisions of major investment banks in Malaysia. So he also served as the president of the Malaysian Futures Broker Association between 2018 and 2019. As a fervent believer in trader education, David has spoken in seminars and workshops to over 5,000 retail traders on trading Bursa Malaysia derivatives, as well as the CME, SGX, and Hong Kong exchange markets. So his work includes the live market trading sessions and webinars. So he is none other than David Loh. Okay, so welcome David to our session today.
Hi, everybody.
Yeah, we are very excited to have you here. All right, so let me just give you the presenter control and you can, go ahead.
Okay, I hope you can see my screen now.
First time we are seeing your webcam. All right,
on the
awesome.
special request from Shane, I've redecorated my room and got in all the equipment to be able to live stream through my webcam. So I hope everybody's seeing that camera going on. This is the first time since our last. This is the 4th. So the last 3 times we didn't get a chance to do video. So at least do it once. It's not too late. So thank you so much, Shane, for the wonderful introduction. Do you see my screen now? Is it been shared? Okay, yeah. Fantastic. And so thanks, Shane, and thank you, of course, Bursa Malaysia Derivatives for hosting and sponsoring this program tonight, and especially all of you who have come in to attend the webinar. Thank you, all of you, for taking the time to come in. This is the 4th in the 4 series. This is the last one, of course, but tonight we have a very, very important topic. We will be talking about the mind game for trading success, and this topic is actually a very, very huge and very wide topic. I was telling Shane before we started that normally my classes for trading psychology is 1 whole day. right? Because we go through a lot of exercises and all that. But never mind, it doesn't matter. This next 1 hour, we will take questions after the session as well. This 1 hour, I will share with you the most critical concepts and the most essential, what do you call that, aspects of trading psychology. So this is like the fully, very concentrated dose of concepts in trading psychology. So hopefully ready, get your pens ready, and get a notebook ready to write down some notes if you want to. There's of course the video will be shared. It's going to be uploaded, and you can go in and revisit the videos. And if you, in case you couldn't understand some of the concepts, as well as the last three sessions that we had previously, will be uploaded in Bruce's website and also LifeGem's website. The links will be provided, so you can go back and see those sessions as well. All right, so let's get on with it. Hold on, let me get this down, minimize this. Yeah. Okay. All right, so this is what we'll be covering tonight. Um, the first thing is we want to understand why trading psychology is the key differentiating factor in success or failure in trading. So this is so important. You see the what they call that, the diagram next to the words here. So it's trading psychology is a multi-dimensional what they call that concept. Okay, it delves into very deep things about the mental framework, about psychology and all that, right? But there are very some key factors that you need to really understand, because if you understand those factors, a lot of it will actually fall into place. The jigsaws will fall into place, right? So in trading psychology, it's so wide and so in depth. It can go very deep. You can go into understanding beliefs, understanding a person's, even his upbringing and its impact in his trading, his what do you call that, how to go in and change beliefs, how to erase beliefs. Those are the things that that is part of trading psychology. But I won't be covering that tonight, of course, because we don't have time for that, right? So we want to understand what are the key differentiating factors. Number two is we want to recognize what are the trader mindsets that lead to profitable trading. Okay, we want to understand where errors come in. Okay, and identify those errors so that we don't make those errors. If you are aware of those errors, at least you know that if those pops up in your trading or into day-to-day trading, you'll be able to recognize it and to solve it. You will say, oh, okay, this is error, I shouldn't be doing it, or I'll try to correct myself the next time, right? And also, what are the success mindsets? Okay, to recognize the mindsets of success in trading. So you ask yourself whether you are implementing those mindsets or not, or do you have that kind of mindsets when you're actually in the trade? So those are the things that you will learn in the second bullet point. And then lastly, of course, we'll look about some certain methods of how to manage emotions and mind states in trading. Actually, in managing emotions and mind states, if you understand the concept of how you approach trading, then a lot of these emotions and mind states will actually fall into place, right? So these are the three key points that we'll be covering in this session tonight. Okay, so this is a familiar slide. You've seen this slide in the last couple of sessions. We talk about the every single part of that makes up a good trading strategy, and we also said that out of all these three parts, the first part of which is methodology, we spent actually 2 sessions on methodology. Okay, important, yes. And then the last session we had money management. Now the third factor in trading strategy, and the most important one, as you can see in this what you call the size of this subset of the trading strategy, is psychology. And this is the most important of all the 3 ingredients in a trading strategy. Without good mindsets, without good trading psychologies, you will not be able to implement your money management that you have or the methodology that you have. Okay, so this is the key. Tonight's session is very crucial. Okay, so let's before we go into the nitty-gritty of trading psychology, let's talk about the market as a whole. What is a market? Over here, you see a picture of this is of course no longer exists. This is a picture of the trading floor on the Chicago Mercantile. It's probably CBOT or CME. You can see all the traders over here. So previously, when they were traded, they were trading face to face, and you can see all sorts of emotions of the people there. You can see here this guy with his hands. Let's see whether I can draw something over here. Okay, so this guy, right? Oops, sorry. Let's see if we can get this pen here to work. Yeah. Okay, it doesn't work. Never mind. You can see this guy. If you can see my cursor, this guy is like a very happy man. He's victorious. He must have got his orders done and making a good profit. This guy stares at him, maybe not doing as well as he is doing. This guy looks very dejected, looking at his order sheets and probably asking himself what has happened to his positions. So there's a whole boiling pot of what do you call that? Different emotions on this pit. Even in this one picture, you can see so many different emotions. Okay, but all these people over here doing the trades, all this make a market. So what is a market? A market is basically a crowd of people placing bets. Well, the word placing bets may not go down very well with everybody, but basically everybody is expressing their opinion of the market. Okay, so a crowd that is what do you call that, expressing the opinion of the market, whether the market is up or the market is down. All of them, when you aggregate all these people, all these trader, it becomes a market. Okay, so that's one very interesting study, okay, and done a long time ago. And when this guy in the next slide, yeah, okay, this guy, a French guy, Gustave Le Bon, he was studying the psychology of the crowd. Okay, studying the crowd. This is one of the early studies. And basically, when he says, when he's looking at crowds, when an individual joins a crowd, okay, individuals like us, individuals like traders, when they go into a market and join a crowd, okay, a lot of things go through. He goes through what we call a transformation. Okay, so a lot of things can happen, and a lot of people, when they join a crowd or join a market or join a trade, okay, whether it's the stock market or the commodity market or futures market, a lot of them lose themselves, cease to operate as an individual. Okay, he loses himself and becomes something a bit like a robot. He doesn't think anymore. He doesn't think independently anymore. Okay, that's why this word called cease to be guided on his own, or guided by his will. Okay, and accepts ideas superficially. Okay, so not only in markets, but it happens in every single event. It can be a rally, it can be a political rally, it can be a group of crowd people championing their rights and all that. So there is always this leader, and you can see Caesar here in this movie, and they have this leader, they chant slogans and all that, and they lose themselves. Okay, and the thing about people losing themselves in the market, okay, and forming that crowd, okay, it something actually happens quite often. Okay, and what do crowds normally do? Okay, crowds normally will do this. Okay, what do crowds do typically in a market? Okay, they normally do this, buying market tops. I don't know whether you do that. I've done that before. Okay, always buy at the highest price of the market. Okay, remember all those people that bought what do you call that, Bitcoin right at the top. Of course, today is back up at the top again. Okay, but in 2017, all right, your auntie, uncle, everybody was asking you about Bitcoin. Okay, and everybody like rushing in to buy at the top. Okay, the other thing that crowds typically do best as well is to sell the market bottoms as well. And I have done that before as well. Okay, during my early days learning how to trade in 1993. Okay, I also sold market bottoms. I also bought market tops. So typically crowds do that. Okay, and in terms of looking at trading psychology, it's how you can control yourself. It's how you can differentiate the crowd in order to make a profit or to consistently make a profit in the markets. Okay, so if you continue to follow the crowds, is essentially you'll fall into these two categories: buying the market tops and selling the market bottoms. Right? This because crowds typically do this the best. So we want to avoid that. So by learning trading psychology and understanding trading psychology, hopefully you will not be in this crowd of people doing these two things. Okay, so trading psychology, a very big word. Okay, what is trading psychology? In a very what do you call that? A concise description, trading psychology is basically the psychology of taking risks. Okay, trading psychology is the psychology of taking risks, right? And when we make decisions in times of uncertainty, right? So every time we go into a market, okay, we make a decision, whether we made this decision through, say, technical analysis or fundamental analysis, or some people go in by their feelings or going by their guts. They see the market is going up, they just follow the momentum. All the time we are basically making decisions in uncertainty because you don't know. Okay, all trades that you do are risky because the outcomes are only probable and not guaranteed, right? If every single trade is guaranteed, you know what to do, right? You pour everything into it, but you know instinctively and intuitively that all trades are risky. And this is risky because the outcomes, you never know what actually is the outcome, and it is not guaranteed, right? So traders, we are all traders, okay, whether it's the stock market or the futures market, all of us are risk takers, okay, who accept the risk inherent in every trade. Okay, so you accept the risk and then you make that trade. Now this particular bullet point, traders accept risk take. Traders are risk takers who accept. Okay, this accept, I put it in capital because some people say they are able to take the risk. Okay, take the risk and accept the risk are two very different things. Okay, a lot of people can take risks, okay, but they may not be able to accept risk. Okay, that's why people can go into the trades. They can lose a lot of money, okay, but they cannot accept taking a stop loss. You see the difference there? They take a huge loss, they can take huge financial risk, okay, but they cannot accept taking a stop loss. Okay, so the ability to take and accept risk, okay, that accept that risk is inherent is in every trade, is actually a very deep concept, okay, which we will go into later deeper. Okay, so the next point is all good traders can accept the risk of possible loss without emotional discomfort. This is the highest achievement if you're good in your trading psychology. You can accept the risk, you can accept a loss with no emotional discomfort. I've put that in bold and also in capital. This is a key concept, right? So the ability to accept risk, okay, without emotional discomfort is the key and the most important skill to learn in trading psychology. Okay, already. So in this particular slides, okay, of course you have this gentleman here, 306 versus 232. So I don't know whether he's taking that loss without emotional discomfort, not. But you know, he seems to have a lot of outbursts with the results of what has happened 24 or a month ago. So but traders need to understand this. You must be able to accept a loss without emotional discomfort, or work towards that. It's not going to be instant, okay? You need to work towards that goal, and that is the most important skill in trading psychology, right? So let's move on. Okay, this is a very interesting slide. Okay, these are news that have hit the lines. One of those articles that I've plucked out on the left is from Bloomberg. Bloomberg talks about this particular hiring by Bridgewater Associates. Bridgewater Associates is one of the world's biggest hedge fund, and they hired the world's best female poker player, right, to become one of their what do you call that, staff. Okay, and then on the right we have this article from the Times talking about this guy also a hedge fund, what do you call that, hiring poker players, okay, because they believe that poker players make very good hedge funds. Okay, and this is a very interesting story, and I want to tell you relate to you a story that happened to me many years early in my trading and early in my career. In the early 90s, I was attending this what do you call that, seminar in where was it? Okay, it was at the Bankers Club in Kuala Lumpur. Okay, and the guy that was giving the seminar was a currency trader, supposedly from JP Morgan. Okay, and he's supposedly one of the very good currency traders. And he was, of course, at the time he was talking about his experience, and of course he wanted to actually get us to sign up for a course. That was like the introductory to the course, and then later sign up for a course. By the time I was still very young and couldn't afford this very expensive course, right? But he was telling us about his experience, how he traded, the biggest lessons he learned. Okay, and we being young and we wanted to like squeeze. We couldn't afford his big seminar, so he wanted to squeeze. A couple of my friends were there with me as well. We wanted to squeeze some ideas out of him, right? And he finally relented and told a group of us and said that if you really want to learn. We were asking what books, can you recommend to us so that we can go and learn and all that, right? So he was saying that the best books on trading can be found where? It can be found in the Las Vegas bookshop. Okay, so that was what he told us. Okay, and I took his advice to heart. So, there's no Las Vegas in Malaysia. Of course, there's Genting up there. But I never noticed there was a bookshop in Genting. But anyway, I went to all the bookshops around in KL and bought up all the books on casino, on poker, on baccarat, on speculating, and on gambling and all that, right? So I wanted to find out what is this guy talking about, the greatest lessons in trading can be learned from these books. And I do realize after reading through so many of those books, okay, and these books are still with me until today. I keep it as a sentimental value because there are so many lessons I've learned there. Of course, one of those, and there are many books on poker as well, as you can see from the evidence nowadays, that what this trader said was actually true, that hedge funds even hire the world's best poker players to become their traders, right? So what are the lessons I learned from those books that I read? Number one is I learned about trading psychology, right? And number two, I learned about money management, right? So those were the two greatest lessons I learned through all these books I read, okay? And all these people, these best female poker players, all these poker players, world rankings, and there are a lot of firms that hire hedge funds and all that hire all these people. What they want is because all these poker players and all these people who have been there speculating on cards on a daily basis, and these are world champions, they are already trained in the key lessons of money management and trading psychology, right? So those are why all these biggest hedge funds in the world hire these people, and there are big lessons that we can learn from that. Okay, so the next slide will take you to some of the lessons and what are the similarities between trading and poker. Okay, so these are the similarities, right? You can see over here. Number one is, of course, we spoke about that, the decision making in incomplete information. With incomplete information, you don't know what is the next card which we're going to be dealt to you, right? So you're making decisions in uncertainty, right? So in the markets are similar as well. You don't know how the trade is gonna, or how the market is gonna move. You don't know for sure, okay, what's gonna happen. Okay, of course, markets can either move up or move down, but you don't know exactly, okay, at that particular moment what the market's gonna do. So both trading and the game of poker are inherently risky because there's no guaranteed outcome, right? In trading, there's no guaranteed outcome from trade to trade. Okay. And number three, money management. As I said just now, money management in terms of trading and bankroll management in terms of poker. Okay, poker basically, when you talk about bankroll, that means what funds they have in their bankroll. The management it's very similar to that of money management. It's basically managing your capital and what risk do you take on every single trade or every single play that the poker player plays. How much of his what do you call that bankroll does he risk? Okay, so extremely what do you call that, similar to money management in trading. Okay, and both of them are very crucial to manage risk. Okay, those of you who have joined us in the last session, we talked about this money management, and it's very similar as well. Right, and without this right money management, even the best strategy can fail. Okay, whether you're a good player or you're a good trader, in terms of your methodology, you have a very good method or a very good way to play poker, but you don't know how to manage your capital, you will also in the end go broke. Okay, so the fourth point is, of course, the psychological patterns of winning and losing in poker and trading is very similar. Okay, so you're making basically a lot of these poker players who are not very good, they are making a lot of emotional decisions, just as we as traders sometimes become very emotional when making the decisions, or the market drives us to be very emotional. So we need to make a lot of rational decisions rather than emotional decisions, right? Yeah, so there's those similarities in trading and poker. Okay, and of course both trading and poker require some conscientious practice and learning. This one point that I will talk a bit later, right? You need to have some sort of practice, and you need to spend time to learn about trading as well, right? Of course, trading and poker are extremely competitive. It's all driven by money, and the fact of money is money always brings out a lot of emotionals, a lot of emotions in people, and we will see some of these emotions later, right? So both of them can resemble gambling if done without education, okay, or in an unhealthy way. Okay, so in terms of trading in futures or even in the stock market, if you don't know what you're doing, okay, you could actually be gambling. Okay, if you go in without education, education is very important. You need to learn about trading, you need to learn about money management, you need to learn about trading psychology. Don't go into the market blindly, right? So you need to have this education and all this what they call that initiatives by the exchange, by the Securities Commission, and even by the brokers, is to help you educate, to give you the information and the education you need to do well in the market. Okay, so education is very important. So we move down to talk about the emotions. Okay, so we saw just now in the slides the ability to trade or take a risk without emotions coming into play is very important. Okay, so let's talk about emotions in trading. Okay, every time you enter a trade, okay, a lot of people lose the logic. Okay, as you can see, before you enter trade, you are in a very good mood. Okay, you talk to your wife nicely, and once you press that button to buy or sell, you can actually transform into a totally different person. Okay, so once you enter a trade, logic can go out the window, and you can become an emotional animal. Okay, why? Because these two emotions come in, the emotions of fear and greed take over. Okay, if you don't have a good hold of your emotions or your training psychology, these two horn guys, fear and greed, will come and take over. Okay, why? Because these two, fear of losing money and greed for making more money, these two of the biggest emotions in trading comes into play. Okay, and let's talk a bit more about these two things. Okay, fear, greed, and also the other one, ego, are the downfall of traders. These are very basic human emotions, and these are part of a very powerful human nature, right? We all have fear, we all have greed. Okay, we all have this ego, right? People don't want to lose money, right? You go into the market, of course, people don't like to lose money. I also hate to lose money, right? So this fear of losing money, this greed of wanting to make more and more money, okay, it sometimes colors their thoughts, colors their ability to make good decisions. Okay, and the other thing is ego. Okay, this is less spoken about, but this is also a very, very important point. Okay, because ego makes you very difficult to admit mistakes. Okay, so if you are very invested in your ego, you tell everybody that you make this once in a lifetime trade, you're gonna make it big, and you tell the whole world that you're doing this. You cannot come off from that particular platform that you said those words, right? So ego is also a very, very powerful emotion that goes through, and we will cover a bit of this as we go in the next few slides. So let's first talk about fear, because fear is the fundamental problem and the key source of trading errors. Okay, fear can come out in various forms. Okay, one is the fear of losing money, which is the most predominant fear. Everybody fears that they go into this either trading or investment. They always fear of this losing money, right? Now, the second one is called the fear of missing out. Okay, so a lot of this the markets this year, because of the COVID-19 situation, when markets actually went down so fast, the market collapsed in March and all that, and then suddenly came back up, and there was this huge what do you call it, fear of missing out. A lot of people just going and piling into the market because of this fear of missing out. Okay, so a lot of people as well, not only in the US markets, but even in our Malaysian stock markets and all that, you can see this emotion of the fear of missing out. Okay, and then what happens when you have this fear of missing out? Okay, you do what crowds normally do best. Okay, that means buying the tops, and you have seen that a lot in the markets lately as well. In the last couple of months, people just pouring in, people borrowing money to pour into the market. Okay, whether they know what they're doing or not, it's another question, but it's the fear of missing out. They're saying that, hey, my friends made so much money, trading this particular stock, or trading this particular futures, so they go in blindly, right? Because the fear of missing out, right? So that is also another of those fears. The other one, of course, fear of being wrong. This has part to do with ego as well, right? This is also one of those fears. The fourth is the fear of leaving money on the table. Okay, this is a fear where you're already making some money in the market, or in that particular trade you're profitable. You have fear of losing that profit this is currently running. Okay, and this particular fear actually makes you take your profits too soon, right? So all these four types of fear actually are the key source of trading errors. Okay, so what are the impact it will have? The impact, one of those impacts is one of the very important one, is not be able to cut losses, or don't want to cut losses. Okay, because although they are losing money in their positions, they fear losing money, they don't cut losses. Okay, and they hold on to positions. So a lot of traders hold on to positions because of these fears. They wait and see. Okay, so in Hokkien, wait and see die. So the more you wait, the more you die. All right, so this overwhelming emotion of fear is one of the key contributors of trading errors. So we move on to look at why fear is such a powerful emotion. Okay, there was this study done in 1991 by these three researchers, Kahneman, Nash, and Taylor. I hope I pronounced their names properly. Okay, basically, the fear comes from this endowment effect. Okay, so when they did this study, they were able to show that the emotion of fear of losses, okay, this loss aversion, that means people feel more pain, from a loss compared to the pleasure of the gain. And they were able to measure somehow that the losses, the pain of taking a loss is 2.5 times more powerful, okay, than the emotion of gains. Okay, so that's very interesting. Okay, so people place a higher value on objects they own relative to the objects they not, which is the endowment effect. And part of that endowment effect is where loss aversion comes in, right? So it's very painful, normally very painful, 2.5 times more painful and more powerful, these particular emotions of pain, loss, of taking a loss. That's why people find it so difficult to take a loss. And cutting a losses is not just a what they call that, a rational choice, but it's an emotional choice. People can't do it because of this particular fear, right? So this is an interesting study done by these three gentlemen. Okay, so if you don't understand trading or don't understand drawdowns, this particular slide, we've done it previously before. Handling drawdowns. What are drawdowns? Basically, in terms of looking at your trading equity, your profits and losses, your graph of your profit and losses goes up and down. Okay, so there are times when there is a drawdown, that means your equity goes down. Okay, those losing streaks, and those losing streaks are unavoidable. Okay, it's part of trading. You know, you can't win all the time, and you cannot have an equity curve that is straight line. Okay, it goes up, and if your trading methodology and your risk management and money management is solid, you'll find that your what do you call that, the equity curve will be uh, moving upwards on an upward slope. But there will still be a time where there are downslopes, which is called the drawdowns. Okay, and that's where the differentiating factor between the good traders and the ex traders, those who exit the market because they lost money or couldn't trade anymore, that is the key differentiating thing. Okay, and of course risk management strategy is one of the key in handling, but also trading psychology is to understand, okay, to be able to take the emotional pain, that losing streak that comes with the emotional content as well. Okay, and we spoke previously on this particular slide. The last time I talked about this is one of the key things in handling drawdowns is to need to have enough capital when you're trading, right? So if you don't have enough capital, okay, and especially if you have capital that you can't lose or you fear losing, okay, or that money you borrowed from somewhere, right, and you cannot lose that money, okay, scared money, this is called, in our trading terms, it's called scared money. Scared money will always lose, okay, because of the underlying trading psychology, what they call that, behind the fear of losing money. Okay, so scared money, not enough money, or money you cannot afford to lose. If you are you're speculating, you're going into the markets with that kind of trading psychology, that is impossible to help. Okay, because already inherently the fear is there. Okay, I hope you understand. That's why it's very important to have enough capitalization. You need to have buffer, because that particular buffer in funds will be able to let you ride through these losing streaks and come back. Okay, if you can't ride through these losing streaks, or what we call drawdowns, you won't be able to sustain your trading. Okay, so this is very, very important in terms of talking about handling drawdowns. Not only is it a technique, a mechanical technique of risk management, but also the psychological, what do you call that, meaning behind scared money. Okay, so I hope that explains why drawdowns are difficult for those who are not or don't have their mind game down well. So greed, okay, we've talked about fear. Let's talk about greed. Okay, greed. What happens when it comes to greed? Of course, greed, you're basically focusing on your profit and loss. Okay, how many times have you, like, make a few good trades, then you extrapolated that graph? Okay, let's say for example you made these nice 3 trades this week, and you made say 1,000 or 2,000 ringgit, and then you start to extrapolate. Okay, like this guy on the right, he's thinking about his money, how he's multiplying his money and all that. Okay, so what greed does is it takes you out of focusing on the process of trading, of managing your methodology and your risk and money management is very, very important. Okay, if you only focus on the money, okay, the greed factor, okay, you forget about the process. And sometimes if you lose money, then these particular emotions will what do you call that, will make you do what we call the revenge trades. Okay, the Hokkien say post you trade post you. So when you're doing revenge trades, you're not following your process. You will tend to overtrade. You will tend to, because you want to win back the money that you just lost. Okay, you will take extra risk. So greed and focusing on the money is one of those key places where trading psychology errors can happen as well. Okay, so take note of that. Okay, yeah. Ego, the third one. Okay, the third most powerful guy. Okay, what is ego? Ego gives you this particular problem. Ego is the need to be right. Okay, you need to be right, and the need to be right is not good, definitely, for your trading. Okay, so there's always this. You can see on the right here this question: do you want to be right, or do you want to be rich? Okay, I think this was one quote from one of the famous traders. Okay, so high IQ and intelligence can be an obstacle in trading success. A lot of people who come into trading are very intelligent people, right? Okay, so sometimes the higher IQ and the more intelligent you think you are, okay, it can be an obstacle to your trading success. Okay, because you think you're so studied into this market, or you have researched all your trades and all that, you've done so much technical analysis on this that you cannot be wrong. Okay, so this is one key problem. You cannot be wrong, or you cannot afford to be wrong, or your ego cannot afford to be wrong. Okay, so this is a very, very debilitating emotion to feel. Okay, because you cannot be wrong. So when you can't be wrong, you cannot take a loss. Okay, and the key things about trading is you must be able to accept and take a loss. Okay, the other thing also, paralysis by analysis. You have so many different. So a lot of people, when they lose money, what is the first thing they think they need to do? Okay, a lot of people think that if they lose money, they need to know more about the market. Okay, they need to analyze more. They need to have more technical indicators. Okay, now I'm using 2 technical indicators. I should use 5 technical indicators, thinking that by putting more indicators, they'll be able to improve your trading. Okay, but actually, by introducing more and more things into your analysis, you will fall into this ego trap. Okay, you will have paralysis by analysis. Okay, you can't react. Okay, so in terms of trading the market, you must be able to react. Okay, if this situation presents itself, what are you going to do? Okay, like a poker player, it's not going to analyze all his different hands. Of course, he has got that analysis already in the head, and he knows how to react when certain cards come up and shows its face. Right, he knows what to do. Right, he needs to react to every situation uh, that comes up, every card that's shown to him, or for a trader, every single situation or trade comes up, what he needs to do, he needs to react, whether to take profit, to add on his trades, or to cut losses. Right, so if you are stuck or you're paralyzed by analysis, or say, wait, okay, I need to consult this particular indicator, after this indicator, and I have another 5 indicators to consult, by the time your position will have gone where already. Right, so it's very important to realize that ego can be a very, very debilitating, what do you call that, emotion to have as well. Okay, and of course, this holding too strong an opinion or view is also very dangerous. Okay, so you need to be very light on your feet. Okay, you shouldn't hold too strong opinion. Okay, now the other thing is also theory versus reality. Okay, so are you very objective in your trading? Okay, when you're very objective in your trading, that means you accept the reality of the market. Okay, the reality is the market can go anywhere, and you may not have any control over where it's going to go. Right, so if you theoretically feel that, oh, you should be right, I've studied all this and these are all factors that have come in, I need to be right, or I have to be right, then you're in trouble. Okay, so we've gone through these 3 very, very important what do you call that, emotions that always cause trading errors. And I want to talk to you about this top 20 reasons why 90% of the traders lose money. Okay, a lot of it you can see from as we run through it. Okay, you can see it's all psychologically uh, related. Okay, so these are the top 20 reasons why traders lose money. Okay, number one is this: not knowing the difference between long-term investing and trading. Okay, and this happens a lot in the stock market as well. A lot of traders go in and say, hey, I'm going to this stock has momentum, I'm going to trade it for the next 2 or 3 days. Right, and after these 2 or 3 days, the stock didn't really do anything. In fact, it went down. So what happens? He said, oh, okay, let me hold this for a week. It become an intraday week trade, and then the stocks continue to go down. Then he holds it for months, and then months become years. Okay, so I've done it before. Okay, those are the things that I've learned as well. I've seen a lot of people do it as well, not only in stocks but in futures trading as well. And it's because futures trading is leverage, that's even worse, right? So you need to understand the difference between long-term investing and trading. Okay, trading is for very short term, and of course trading, if you're good at it, the returns are very handsome as well. Long-term investing is about very steady gains over time. It's a buy and hold strategy, so it's very different. So if you're trading, you trade. If you're investing, you invest. So you need to differentiate that. Okay. Number two is underestimating the risk and leverage. Okay. So we spoke of that in risk and money management. We spoke of that even in the methodology. You must be able to understand the risk and understand the power of leverage. Okay. So leverage can work for you, and leverage can also work against you. Okay. And the third one is very, very, very this is very deceptive, okay? Especially for those who come into the market and in the first few trades make money, okay? And they are deceived by the thought that trading is so simple. They say, wow, this is like so, so easy to make money. I'm fantastic, I'm a fantastic trader. So he thinks that trading, okay, by winning the first few trades, he's a good trader. Okay, so this is a deception, because the deception is that trading can look so simple. Okay, trading can look simple, okay, but it's not necessarily easy. Okay, so the key to trading is actually consistently making profits. Okay, so this is a trap that a lot of beginners get caught into it. Okay, they think it's so easy. Okay, after the first few trades, then the greed comes in. Remember, the greed comes in and it starts to extrapolate. Okay, and then if he will start to put in a lot more capital and take a lot more risk. Okay, so this is a deception that you need to recognize. Okay, trading needs study, needs education, and needs experience. Okay, so that comes to the fourth point, which is no training before trading. Okay, realize this: every time you enter into a market, every time you enter a trade, you are trading. Possibly, okay, with the savviest and expert traders, you have robots trading on against you on the other side. Okay, so if you have no training, okay, and if you're not prepared before trading, you are trading actually at a big disadvantage. Okay, so this is a very important point. Okay, and because it comes from number three, the deception that trading looks very simple. So he feels that, oh, there's no training, no, I can take the risk, and not accept the risk, can take the risk, no trading. So please bear this in mind. You need to have experience, you need to have a good system, okay, before you go all out on your trading. Okay, number five is starting off undercapitalized. We spoke about that, the scared money, right? Scared money always lose. Remember that, scared money always lose. So if you have scared money on the table for trading, my best advice is take that capital out from your trading until you have enough capital, then only put it at risk. Okay, this is very, very important. Okay, which leads us to number six, which is using money that isn't truly risk capital. Trading, it's always, every time you sign that risk disclosure document, when you open an account to trade either stocks or futures, you have this risk disclosure that you must understand that you must use and trade with risk capital. Very, very important. Trade with risk capital. Okay, not money you cannot afford to lose. Okay, definitely not your baby's milk money. Okay, definitely not with your what do you call that, your children's education fund. Okay, this is very important. Okay, seven, overconfidence. Okay, which is very related to number three. Okay, this is a beginner's mistake. Okay, winning a few trades and thinking that this is like no problem, I'm already a good trader. Okay, and it's just only done 5 trades. Okay, number eight is wanting to be right. This is an ego problem. Okay, wanting to be right instead of making money. You recognize that that's an ego problem. There's a trading psychology error. Number nine, listening to other people's opinion, OPO. Okay, so you base your trading on news, you base your trading on rumors, you base your trading on social media feeds, Instagram, Facebook, and all that. Okay, that means you're not making a measured and well researched idea. Okay, not overly research. I'm saying that you need to have a decision made on rational. Maybe it's a methodology that you use, technical analysis, okay, or you have a good fundamental analysis for long-term trades. This is very important. Listening to OPO or other people's opinion won't cut it, okay, because other people have different what do you call that, agendas, okay. Rumors, people who spin rumors or spin news on the social media, they have different agendas, okay, and most of the time that agenda is not to make you rich, right? Now, number 10, trading for excitement. Okay, this is another thing. This is probably a greed factor, okay. So this has no basis on good trading, which is trading on excitement. Excitement is an emotion, okay. The next, number 11, lack of money management. Okay, so this we spoke about already. Lack of methodology. These are the two key ingredients we need to have. Okay, plus trading psychology. Having trading rules you can't or won't follow. This could be a trading psychology error as well. After making a few losses in a row, you can't pull the trigger. Okay, you don't want to follow the trading rules anymore because you forgot that there's drawdown. Every time you trade, there's a drawdown. Okay, so you forgot that. Okay, so you don't want to follow the rules anymore. So you again, you default to either listening to rumors, okay, or following your instincts. Okay, number 14, having unrealistic expectations of trading returns. Okay, this is a very important point as well. This is another trading psychology error, which is greed. Okay, so if you go into the futures market and you have highly unrealistic expectations, okay, or you took some risk, money that you couldn't afford to risk, and you want to make some huge trading returns for some reason or another, you needed the money fast, normally you will lose, because this is one of those reasons why people lose money. Okay, over trading, we spoke about that, both in size and frequency. It could be greed, it could be revenge trading, it could be ego. Okay, lack of discipline. Okay, this is another, not wanting to follow the trading rules that you have. Lack of patience. Okay, this could be greed as well. Okay, number 18, seeing trading as a hobby and not a business. Okay, so you're just mucking around, you're just playing. Okay, so if you are playing in your trading, a lot of professional traders and are very happy to take your money. Okay, so if you're willing to let go of money, a lot of people are all too happy to take it. So don't see trading as a hobby, take it more seriously. Okay, look at it as a business. Okay, and then you will trade better. Okay, which brings us to number 19, which is trading without a plan. Okay, you trade as a hobby, normally there's no plan. Okay, you go in there and you just make a few punts hoping to make some money, and you miss a few of these punts, you cannot take accept a risk, then you don't take a cut loss, and all that will turn into a disastrous outing. All right, and the last one is trading hunches. Okay, that means you don't have a methodology, you trade by I feel. Okay, you may look at some charts, okay, but you don't actually have a methodology. You're just fooling yourself. You're looking at some charts, then you say, no, I feel. So every time you see yourself or you catch yourself making a trade, you ask yourself a question. If you say I feel that the market is going up, or I feel, when you say I feel is from an emotional origin, right? So you need to be able to ask yourself the basis of your trade. Is it a rule that you have and it has triggered that particular setup? Say a trading setup, it could be an ABC setup or a momentum indicator setup, which we spoke about in the last two sessions. Those are the triggers, and there's no feeling there's no I feel into it. The signal is there and you execute that signal. Or if you certain fundamental analysis key in what do you call that, measures that you have already in, then you do it. You don't use the I feel, because I feel comes from an emotional origin. Okay, hunches, right? So those are the 20 top reasons why traders lose money, and 90% of that's a very set what do you call that, percentage actually, but 90% of people lose money because of these 20 reasons. Okay, so by be able to recognize these pitfalls of these areas of errors, you will be able to more or less recognize that if you are in any one of these categories, you need to improve, or you need to get yourself out of this, right? So now we move on. Okay, we move on to an interesting part. Okay, hopefully we have time for this. Okay, now we're going to talk about the models of successful traders. Okay, and when it comes to models of successful traders, it is got to do with things called beliefs. Okay, because what you believe will affect your actions. Okay, how you act is a or has its origins in your beliefs. Okay, so let's talk about trading beliefs. I think we have some time, and we'll take some time. Shane will flash some what do you call that polls. Okay, and asking this question. Okay, he'll put up one trading belief. Okay, and you answer yes or no. We want to sort of like poll your response to it. The first one is the market is a safe place to invest and trade. Let's put a poll on that. Okay, we're going to
All
open the
right.
poll. You just respond by clicking. Yeah, Shane will help
Yeah,
me
the
with
poll
this.
is up. Yeah, the poll is up.
Yeah, so just respond to this. Respond to this
Yes or
trading
no?
belief. The market, yes, the market is a safe place to invest or trade. Yes or no? Okay, your gut feel.
Okay,
Just key
let me
in
just,
yes or no.
yeah, let's do it for another,
Hmm. So what
15
do we have for
seconds.
this? Okay, so quickly. Okay,
Okay, we
we
have
have still got
60 over percent voted.
yes. 60% yes, or no, we haven't got the yes or no yet.
Okay. All right, so
Okay.
let me just close the poll. Okay.
Okay.
Wow. Let me share with the result. David, can you see the result?
Okay, I need to click on it, right? Okay, let me click on it.
Can you see the result? I've got it on the screen.
Oh, I can't see it somehow. Yeah, I think
Oh,
wait, I
it's
need to
50-50.
oh 50-50.
It's 50.
Okay. 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 So
Yeah,
let's move on to it.
50% yes, 50% no
Okay,
lah.
let's go into the next one.
Okay, let me just launch the next poll.
Yeah.
All right, the market is a dangerous place to invest or trade. Yes or no? Yes or no? Okay, so I give you all 30 seconds to answer this.
Okay. So respond to this. The market is a dangerous place to invest or trade. Is very similar to the first one, but some people have a different response to this, although it's just the opposite of the first one.
Mm.
Okay, what do we
Okay,
have?
we have 70% of people voted. So 43% say yes, it's
Okay.
dangerous. 57%
Mm.
say no, it is not
All right.
dangerous.
You have a group of
Okay,
people who can take risks here. Okay, let's go to
okay,
the next one.
okay. The
So
next one
statement
is
is,
you can easily make money in the market. Yes or no?
yeah.
Okay.
Who believes that? Who believes that you can easily make money in the markets?
If you believe that, click yes. If you don't believe, click no. Okay. Let me just open for another 10 seconds. All
Yes, you
right.
can easily make money in the
So
markets. Yes or no?
you,
So what do we have?
so the result here is 37% feel that yes, can easily make money. 63% feel that no, it's not easy to make money in the market.
Very interesting.
More people
Okay.
favor no. Okay.
Okay, next we'll go to big players control the markets and it's hard for the little guy. Okay. This I hear a lot from the people, you know. Okay, so we'll put up the
Okay.
poll, and as you respond, I'll explain on a bit on this. Okay, this thought
Okay.
about big players control the markets is hard for a little guy. Every time I put a stop loss, this big player know my stop loss. They always trigger my stop loss. I hear this all the time. They seem
Yeah.
to know where my stop loss is. Every time it goes up there, takes out my stop loss, and then goes back to where I was originally correct. Right. So
Yeah.
so that has some origin on this as well. So what do we have there, Shane?
Okay. All right. Let me just wait 5 more seconds. Okay, we have 70% voted. The result is 63%. That means two-thirds of you
Mm.
feel that yes, big players control the market, whereby 33%, feel that no.
So it's quite prevalent that the thought of big players actually control the market and it's hard for the little guy. We go to the next one.
Okay.
Okay,
It's
it's
tough
very
to
similar.
make money in the market, yes or no?
Yeah. Who feels it's tough to make money in the markets?
If you feel tough, then check yes. If you feel not tough, check no.
Mm.
Okay, let me just open for another 5 more seconds. All right, we have 59% feel that yes, it is tough to make money. 41% feel that no. Okay, it is
Mm.
not so tough to make money in the market. Okay, that
Okay,
means it's
this is an
easy.
encouraging result as well. So we do have a crowd that is profitable, which is good as well. So let's go to the last one. So
The last
the
poll,
statement is, yeah, last poll. The statement is you need to have lots of information before you can trade profitably. Who believes that? Yes or no?
right?
Okay,
Give
these are some
you
of the common. Yeah.
15 more seconds to answer. All right. So, okay, let me just close the poll and share the result. So 65% of you feel that yes, you need to have a lot of information before you can trade profitably, and 35% of you feel that no. Okay.
Okay,
Yeah. So
thank you
more
very much.
people
That's a
feel that
very
you
good.
need more information.
Yes, yes. Thank you so much, and thank you, Shane, for helping me on this poll. So we have a very interesting responses, okay, to this few of the common trading beliefs in the markets. Okay, so these are how people actually feel, and you've already polled the results as well. You can see quite a different range of responses. Okay, and all these responses and how you believe this all this market what do you call that so-called trading beliefs will have an impact on how you act. Okay, and each of this is let's say for example the first and second one, the market is a safe place to trade and invest, the market is a dangerous place to invest or trade. These two looks opposite, but the thing is it's very interesting that you as a person who is a trader may have this belief change over in a matter even of on the same day or even the same week. You can have and hold this belief, these two seemingly opposite beliefs, okay, at the same time, okay, even in the same day or in the same week. Okay, but if this is a constant belief, okay, if you see yourself constantly believe that the market is a safe place or constantly believe that the market is a dangerous place, it will have a very, very profound impact on your trading, because these beliefs make you act in a certain way, right? So if let's say for example you had a string of stop losses take you out, okay, you will likely feel that the market is a very dangerous place to invest, right? That is that's an emotional what do you call that response coming out from the most immediate experience in the last maybe 5 to 6 trades, right? But if you had the experience of having 5 to 6 trades winning trades, okay, you will have a totally different belief, okay, that the market is a safe place, it's a easy place to make money in the market. Okay, your beliefs will change. Okay, but the key thing is what you have as a consistent belief. Okay, if you have a good, consistent, correct trading belief, then it will constantly and consistently drive the actions that you take. So if it's a what do you call that, a belief that enhances your trading, then the result of acting on that particular belief will have long-term results in your trading. Okay, so we will have to look at this, because trading beliefs is about mindsets and what you think and how you see the market fundamentally. Okay, so we have 2 slides to talk about these trading beliefs. Okay, so let's talk about the mindset of successful traders. Okay, so what are the 6 mindsets of successful traders? So as we go through these 6 mindsets, so you can look back and reflect okay, compare that to your mindset, okay, of how you think, okay, and how you react. Do you have these mindsets? Okay, if you don't have these mindsets, then you strive to have these mindsets of the successful traders, because these are the models, okay. So it's like modeling. If you follow the successful models, then your actions will be what do you call that? It will be source, or is originate from these successful mindsets, and your results will reflect that of the successful traders. Okay, the first is to take responsibility for all your decisions and all outcomes. Okay, you must accept responsibility for all the decisions that you make and all the outcomes that come out from those decisions. Okay, that means the ability to accept risk, which is one of those first few slides that we had, is very fundamental to this. You must take responsibility. Okay, you cannot say that it's the fault of the market, or it's the fault of the big players, okay, or it's the fault of my broker, he never give me good advice and all that. Okay, all trader decisions are made by you, okay, and all the outcomes, you must make the decision. You must be the driver in your seat. Okay, so that's a very important mindset of a successful trader, right? So that goes back to that particular point we had just now about the trading error. If you make trading decisions based on OPO, other people's opinion, okay, then you're not taking full responsibility for the decision, because if you're wrong, who are you going to blame? You're going to blame that CNBC commentator, or you're going to blame that research report that somebody put out, or you're going to blame that Instagram posting, or that tweet that you saw last night. Okay, so you must be able to differentiate that, right? That's number one. Number two is trading is going with the flow. Okay, that means you must go with the flow of the market. Okay, okay. Sometimes you have your drawdowns and you're going with the flow. You're not upset with it. Going with the flow is that means trading is easy and not emotionally disturbing. Okay, of course, I saying it is a lot easier to do, but it's a process that you have to go through. Okay, everybody in terms of reaching this goal of trading with the flow, and it can be a difficult and very challenging process. Okay, and I've gone through that as well. Okay, I retired from my corporate work and trading full time. When you trade full time, it's very different. Okay, it's so very different. Okay, and the thing about trading psychology and all that will come in. Okay, and even okay, after so many years in the business, when you're doing it seriously and you're doing it full time and doing it for a living, it's way different from trading on a part-time basis and all that. It's very different. Okay, number one is your whole trading psychology is so different. Okay, but it is a process that every trader has to go through, right? To become a good trader, you have to go through that pain of learning, right? So trading with the flow is one of the key things. Once you achieve the flow, that means you are able to go in and go out the market, whether it's a loss or profit, with very little emotional content in your trading. Then you are with the flow. Okay, that's what it means by being in the flow. Okay, the third is understand that the market is not the enemy or the threat. Okay, this is how we had some beliefs, right? Do you believe that it's the enemy or it's a frightening place to be in? Okay, you need to understand that the market is not the enemy or the threat. Okay, who is the enemy? The enemy is actually ourselves. Okay, so we need to get out of our way. Okay, in trading, we need to get out of the way. As in the second point, you need to go with the flow. Okay, the fourth point is to trade without fear. Okay, so that is, as we said, fear is the most predominant and the most what do you call that contributing factor to your trading errors. You need to trade without fear. Okay, and it comes with trading with very little emotional discomfort. Okay, that's the key thing. The third is, this is very important as well, and we will go into the next slide, and you'll see this. Understand the probabilities and your edge. Okay, so this comes from doing your homework. Okay, doing your methodology. Okay, so we went through the methodology of the ABC. We went through the methodology of the momentum. Okay, we went through even one of those trading system by Ryan Jones, which had a fantastic money management and trading statistics. Okay, now the thing is this: if you don't have a trading system, you got to ask yourself, why am I not implementing ABC? I'm not saying that ABC is the only method to trade, okay? But you need to ask yourself, why are you not implementing an idea? Have you tested it out? Okay, a lot of people ask me the question of how good is the system and all that. But then when I ask them whether you have tested it themselves, they normally say no. Okay, so they rather listen to the OPO again, other people's opinion. Okay, other people's opinion that the system is good or bad, but they never tested it, they never back tested it. Okay, they never went in to review their trades, taking some, maybe it's a paper trade, whatever. You never tested it for like last 6 months, or you've got use a system to back test the system. Okay, that you, so you need to be able to know this, because by understanding the probability, the confidence that you have tested the system, you know the numbers, you know your edge, then you'll be able to implement that particular trading system. Okay, so no matter how good a trading system you buy it off the shelf, or some guru taught you that, or this guru could be the best trader in the world. Okay, it doesn't matter, because if you have not done it yourself and you don't understand the probability of this particular system or your edge, then you would have a problem. Okay, so that's very, very important. Okay, the last one is, of course, seeing the markets objectively, right? So the market's never against you, the markets was never set up against you. Okay, the market moves as it moves. It's got global factors affecting it, supply, demand. Okay, and even like the coronavirus the situation, all this you can never foresee, right? And it's objective. It's got nothing against you. Okay, it's the market don't favor you, or the market don't actually go against you, right? So you need to see the market as the reality of the market. Okay, so if you put emotional content into your trading, or you trade subjectively by using those emotional content, whether it's a hunch or you trade with emotions, then you are not seeing the markets objectively. Okay, I hope that clears up. Okay, and the next one is very important slide. Okay, and I would recommend you to okay, next one. Let me go to this. Hold on a second while I'll go to the next slide. Okay, somehow.
I think you're on the drawing tool because your cursor looks like it's on a pencil.
Yes, it is. Yeah. So how do I get out of this? Do I just normal? Erase all drawings. Okay. Okay. Go to a. Seem to be stuck in
Do
the
you,
drawing tool.
do you want to click like space or some button on your keyboard?
Okay. Never mind. Let me try this again.
Okay, yeah, I think you have multiple screen.
Okay, so let's go back to this. Okay. Okay, then I'll have to get this out. Okay. Hopefully we're back. Shane, do you see the thing?
Yes, correct. I see, but you have to go to the
Okay.
next slide.
Okay.
All right,
Yes.
cool.
So this is a very, very important slide, and this is the last slide. Okay, and this is very important. We've taken some time, but please bear with me on this. Okay. After you learn this particular slide, I will encourage you to go and reference this book by Mark Douglas. It's down here. Okay, Mark Douglas. The book is Trading in the Zone. Master the Market with Confidence, Discipline, and Winning Attitude. This is one of the best books on trading psychology. Okay, that I have read, and I've read quite a number of books. Okay, and this is what you want to understand: the 5 fundamental truths of trading. And these are, if you believe these 5 fundamental truths, okay, and your actions on your trading will follow on a very, very different path. Okay, so the first fundamental truth: anything can happen. Okay, this is a fundamental belief you need to have. Anything can happen. Okay, that means every time you go into a trade, anything can happen. Okay, regardless of how well studied or well researched, or how your technical analysis, how powerful your technical analysis is, anything can happen. Okay, so in terms of the top world-class poker players as well, they don't know what kind of cards will be dealt to them, what kind of hand will be dealt to them, much like the same way as traders as well. We don't know what's going to happen next. Okay, nobody would have foreseen, okay, in beginning of 2020, before Chinese New Year, that the coronavirus situation will happen and the market is going to tank like that. Nobody, right? So anything can happen. Okay, not only what is going to happen in the next 5 minutes, even in the longer term, the next 1 year, nobody knows, right? Okay, and if you can hold on to this belief that anything can happen, then your trading will be very different. Okay, the second one, which is related to the first one, is you don't need to know what is going to happen next in order to make money. Okay, now that seems to be like, wow, okay, you don't need to know what is going to happen next in order to make money. What does that mean? You have full confidence in your edge. We spoke about the edge and knowing the probability of the system. Okay, you know that even though I may not know what's going to happen next, I know that if I do and follow my trading system for the next 20 trades, okay, because I have an edge in it, okay, I will make money. It's very similar. How does a casino operate, or how does, say, a company like Sports Total or those totalizer companies what it can operate? Okay, it operates on a long-term assumption. Okay, although the payouts can be quite high, 60-70%, they know at the long-term, what do you call that, long-term, they have the edge. The casino has an edge, right? Las Vegas has an edge. Those people who operate casinos have an edge, so they're not afraid that you make money. Okay, if your casino customers, you come and take money from them, you make a lot, you make millions, they're not afraid that you take money from that. They're only afraid that you don't come back, right? So in the same way, you need to tweak your trading to be like that. Okay, you have the edge, so it doesn't matter if you make a few losses in the next couple of trades, because you know next 10-20 trades you have this particular edge, and this edge will always work for you. So that's very important. Okay, so you are not invested in every single singular trade. Yeah, you don't really matter to you. Okay, okay, and that leads to the number three. Okay, number three, there is a random distribution between the wins and losses for any given set of variables that define an edge. Okay, that sounds like a very big mouthful. What is saying that you have a winning formula? Okay, say for example, you have a winning formula that you know that in 20 trades, these are your statistics. Okay, but you don't know which occurrence will come first. You don't know whether the first trade is going to be a win or loss. You don't know whether the second trade will be win or loss, which is a function of the first two beliefs. Okay, but you know that in 20 trades, you will have that particular edge. You just don't know what is the sequence. Okay, it can be a win, loss. It can be a loss, win. You don't know the sequence. Okay, and you don't really worry about that because you are in it for the long term. Okay, so those three beliefs up there is fundamentally, of course, also connected. Sorry, not the last one, the fourth one is an edge is nothing more an indication of a higher probability of one thing happening over the other. Okay, that's why the edge is so important, right? So it's basically, in a set of occurrences, you will at the end of it make money. Okay, that's what it means. And the last one, every moment in the market is unique. Okay, just because that's why in a lot of these research reports, and they always say, the past does not necessarily reflect the future. All the mutual funds that you buy, they always have this disclaimer, past performance is not an indicator of the future performance of the fund and all that, because they also realize in the market every single moment is unique. Okay, so these are the 5 fundamental truths from this fantastic book by Mark Douglas. I find it so useful, and I find that if you can honestly embrace these 5 fundamental truths, okay, you will find that your trading will lose a lot of its emotional discomfort. Okay, but of course you need to have the edge. It's very important to have an edge, and the edge can only come from you experiencing the system and getting the statistics out of the system. Okay, so this is the last slide. Okay, we have gone through a lot of time in doing all this, so now we open to question and answers. So Shane, do we have a lot of questions coming up from the audience? It's time for you to ask
All right.
questions. We have some time for questions.
Yeah, we got some questions on the screen right now. So the first question is asked by our friend here, William. How do
Yes,
we
William.
ascertain how much capital is adequate to engage in trading?
Okay. Of course, it depends on how much the sizes that you are willing to do. Okay, at least for me, I need to have to my comfort. Let's say, for example, I'm trading palm oil. Okay, so palm oil margin requirements about 5,000. Okay, normally I will have 15 to 20,000 to trade one lot of palm oil. I know it's very conservative, right? I'm very conservative. Okay, I have lots of what do you call that? Enough capital to do that. But if you have, let's say, for example, you don't have to follow me, okay? If you have less capital, then you either move down to a shorter time frame. You may have to move down to, say, instead of trading daily charts, you trade hourly charts, or you trade 15-minute charts, or you day trade. Okay, so those time frames are less risk. So with less risk, then your stop losses are tighter. You don't take that much risk per trade, so you can have less capital. Okay, but still have a lot more comfort than is normally necessary. Okay, this may not necessarily so a lot of people actually trade a lot more aggressive than is required. But at least I think the minimum is at least need to have double the margins you require per contract. That'd be a good starting point. I hope that answers the question. Shane, back to you.
All right, sure. The next question is, what do you mean when you say seeing the markets objectively? This is by Jason Wong.
Mm. So seeing the market objectively, basically you don't inject your views into the market. Okay, you trade your system, of course. Your trading system, whether it's fundamental or technical, will of course give you an indication, right? So you follow that indication without the emotional content. Okay, so if let's say, for example, you're trading the ABC system, and then there's a ABC setup and it's a buy. Okay, so what the ABC says that basically based on that, then the momentum is up, it's broken up, that breach that particular point, and you have a buy setup and you go in. Okay, so you are being objective, number one, because of your system. You don't have emotional content. Okay, the other thing is seeing the market as it really is. Okay, number one, the market is not against you, right? Against you means it's got nothing against you, right? It's not an evil thing, or it's not something to come and save you as well, right? So you see it that way. Okay, so it's very objective. It's you see the true reality in it, and a lot of times the true reality of seeing the market is through the price action. That's why a lot of traders go into price action, because that seems to be the purest form of objectivity. So they look at the prices, and how the prices react, they will act accordingly. Okay, that seems to be a movement in terms of price action type of trading systems. I hope that answers your question.
Sure, I think it certainly does. The next question is by Cochran. What do you think about algorithm trading,
Mm,
since it
mm,
eliminates all human emotions and relies
mm.
on computational data?
Mm. Okay, I trade algos as well. Okay, algos can be different type. Of course, it can be full automation, or okay. So even though I teach the ABC and all that, that's manual trading. That means you look at a chart and then you trade. Okay, I do use algo as well. So I have a algo generating ideas for me, and I trade. Now, what I feel is that even though you have an algo, right? If your algo goes into a what do you call that? What do you call that? Drawdown. Okay, the human being, because who controls the algo, right? The algo is also controlled by human being. Whether you want to switch on that particular algo strategy to let it run or not, it still depends on the human being, right? So when your algo goes into a drawdown, do you switch it off or not and say, hey, maybe this algo is lousy? Okay, or you don't believe in the statistics that the algo give you in terms of the backtest. Of course, in terms of backtest, some backtests, some algos may not last the long term, because market factors change or market conditions change, right? But then the human factor can even come into algo. But one of the most powerful things of algo, especially in executing, okay, and I find it helps me because all my orders are already parked there. I don't, when the prices come to a certain price point, I don't need to like hesitate on that, because it'll be done. It'll be automatically done for me. So half the battle is gone, but doesn't mean that trading psychology is not an important part, because you as a human being can still switch off the algo. Okay, you can still question your algo, the same thing as you question your technical analysis system, right? So, but algo does help, okay, but it's not a magic bullet. Hope that answers the
So
question.
does your algo automatically adjust the right size for you and to help you
Uh, it,
to the algo give you a
it,
signal, or
mm.
it immediately help you to enter the order and close the positions?
Okay, there are algos that can do position sizing for you as well if you use it. Yeah, it can automate position sizing to set up the optimal sizing as well. It can do that. It can do it manually. Okay, that means at start of day you determine you already tweak the parameters for the size. Okay, you can do it both ways, but the algos can do position sizing as well.
Can,
Mm.
can can it help you to place orders immediately, or you just generate signal and you have to place your order yourself?
Okay, if your algo is integrated with the execution system, yes, you can even execute the order for you, and that's ideal if it can execute for you, so that you don't really have to worry. You just monitor that the orders that is gone in is correct. Okay, as it executes, yes, algos can do execution as well.
All right. Yeah. The next question is by Richie, which is
Mm,
the casino design the game rules or the payouts to have an edge over the players.
mm.
So, but in the market, how do we design our plans to have the edge over the market? Because we have to follow the market rules and not our own.
Mm. Your edge comes from either it's a technical analysis signals that you have, okay, that or a fundamental system that you have. So, how do you know your edge? You need to know the statistics of your particular system, right? So, let's say, for example, if you backtest 10 years data, okay, and then you look at what is the result, what is the equity curve like, what is the drawdown, all those statistics must be, in your fingertips. So then you are confident that for this particular trading system, you know that this is the win-loss ratio, this is the win percentage, and you have confidence that of course, all the other statistics apply as well. So from there, you get your edge, right? So mathematically you have counted that from this particular system, you can get this particular edge. Just like the casinos, of course, they have mathematical great mathematicians. Every game is already pre-calculated, the payouts and all that. Some of them, maybe like a game of baccarat, sometimes they don't even need to charge you commission, but they know, okay, by the banker's edge of taking a bit off every time the bankers what do you call that win, you take off some commission. That already is a winning edge for them. So in terms of trading system, you need to have that particular edge. Okay, that means in the long term, your expectation is positive. I hope that answers the question.
Yeah, certainly is. The next question is asked by Iqbal. How do we avoid selling early?
That means this is profit taking, right? Yeah,
Yeah,
it's not easy.
because
It's not
usually
easy.
closing the position is the toughest part for us to do.
Yes, yes. It does go back, number one, to also again your edge and what is your win loss ratio and what's your profit. Okay. Let's say for example, in some of the systems that I trade, I know what is my profit target. Okay, I know statistically across say 2,000 over trades, real actual trades in the system, this is the profit target. So I put in a profit target. So I do have a profit target. I do have a risk parameter. If that's the loss, that's the stop loss, I will take. But I also have a profit target, right? So it's good to have a profit target to do that. Okay. Sometimes in terms of let's say if you don't trade an algo, sometimes it's also good that, let's say for example, if the market has moved over a certain period of time but has not reached your profit levels, okay, let's say your profit taking is say 50 points and it's gone like to 40 something points, right? You may want to move your stops, okay, your stop loss to either break even or take 1 times your profit, so that gives you a bit of the psychological comfort. Okay, you can tweak that, and of course you can test that as well. If you do that over the system, does it work for you or it works against you? right? But then that is to gain the psychological advantage, knowing that after you've gone a certain amount of trade going for you, then this trade will become a lossless trade. The worst thing is to have a trade that goes well for you and then suddenly turn and now takes you out, stop loss, right? That feels really lousy in terms of trading psychology, right? So you may be able to tweak that a bit. Right. So there's no magic formula, but if you have a statistics of that particular profit target that's consistently being achieved, then you can use it as your profit target to put there, so that you know that you don't take your profits too soon. I hope that answers the
All
question you've
right.
got.
Yeah, thank you so much, David. It has always been a pleasure to learn from you, and every time I host you on our webinar, I always find it very very a lot of information for us to take, and with action plan on what we can do next, in our trading journey. All right, so thank you so much, David. So let me take back the presenter control to show you my
Thank you.
screen. Talk about next webinar. So the next webinar is going to be on this Malay session. So it is on pengurusan modal dan risiko dalam pasaran niaga hadapan. So it's happening on 10th of December. It's a Thursday, 8:30 to 10 o'clock. So we have just given you the registration link. So if you you find this topic of interest to you, please hurry up to register, because we can only host a limited number of people online. So last but not least, we also have a post-webinar survey for you. And for those of you who help us to answer the survey, we will pick 6 of you who answer our survey. Will walk away with a Touch and Go e-wallet reload pin worth 50 ringgit. I'm sure that many of you have already won that before already. So, but we still have more to give away. So the survey will be launched after this webinar, and will also be sent to you via email. So lucky winners will be reached out within a week. So not only you join our webinar without any charge, we will also give some of you here some money to spend. All right. So thank you so much for supporting our webinar so far. So we hope that you find these sessions very helpful. And this is the last sessions that David have for this year. So we hope that we hope to have David back with us next year to share with us more. Okay.
Keep on.
So
Yeah.
thank you. Yeah, God willing. Okay. So thank you very much, everybody, and may you all have a pleasant rest of the day. Bye bye. Thanks, David.
Bye bye. Thank you.
Yeah.